This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Nigel is joining us, and so is Sonia in just a bit from now. Well, I want to quickly kind of, without wasting any time, tell you what you need to know as far as today's session is concerned. Let's kick this off. I'll introduce Sonia and Nigel in just a bit. Well, so the market ended lower yesterday, but it held above support levels, right? I mean, things looked down, but not completely out. That 40-day exponential moving average, which we've been talking about, was very much at play. I'll get to levels in a bit, as we always do, but it's weaker global cues once again. The handoff is weak from Wall Street. Nasdaq up on your screen, 1.17%. The Dow was down 0.8, 0.85, and the S&P was down as well. What's the basic issue? The basic issue is surging U.S. Treasury yields. The 10-year is now basically at pretty much cycle highs at 4.34%. Which basically is also a major resistance. We left off at about 4.28-ish yesterday, and we are just knocking at that major resistance level. Hopefully, the 10-year does not cross this and keep going. That's the bet here. The dollar index is also holding no large movement overnight at about 103.4. Month to date, the numbers are starting to stack up, right? So Nasdaq is down 6.5%. The S&P is down about 4.2%. And you got the Dow, which is down about 2.5% as well. Till the middle of last month, things were looking up and up, right? It was there were ripping rallies, and now some of these rallies are being really sold. Underlying all of this, and I said this before, the problem in the US is it's not so good, but I mean, just to use a phrase, it's so good that it's actually bad. Data is strong. It continues to be strong, and despite Fed's 500 basis point worth of rate hikes, it's not causing any damage to the economy. And why do we need damage to the economy? We need it for inflation to come off. But data is strong. So US data, what we got yesterday, which is the Philadelphia Manufacturing Index, the Fed index, which saw the largest rebound in 3 years. You also had the initial jobless claims which came out yesterday. They were also in line with expectations. They fell in line with expectations. So I'm not really mentioning that. Basically, the bets are that the Fed will have to do more. In terms of hiking, etc. Maybe not in September, maybe they skip, but later in, towards the end of the year, there are more hikes done. The hikes are not done. And that's what's being repriced into the market here. Just to come back to the levels and what you need to know. So the 40-day exponential moving average is at 19,360. We left off 5 points above that. That's the first kind of level on a closing basis, right? Now, of course, right at open, that will go. But let's see how things progress toward by the end of the day. It's also the weekly close. So it'll be important in terms of how that is. A positive weekly close and a negative weekly close, I mean, I think, it makes a fair bit of difference. And hopefully, perhaps through the course of the day, we get some recovery, some bounces. On the way down, I would say it looks a little sort of likely that perhaps eventually we do get to the recent low and perhaps even a little lower than that. The recent low was about 19,257 or so. Watch out for that. Resistance at 19,498. That's a 61.8% retracement of the recent fall. This is a level we've put out, but I don't think that's coming into reckoning anytime soon. The Bank Nifty has been the weaker of the two between the Nifty and the Bank Nifty, the Bank's index. That is trading at the 20 weekly moving average, which is 43,873. Again, pretty much exactly at the 20 weekly moving average. Perhaps that goes a little lower than that. Resistance at about 44,175 or so as well. So, the picture is not looking all that great. And perhaps the best thing to do is not try and trade too much. Trade if you must. Take positions on stocks, etc. But, I mean, it's getting choppy out there. It's getting a little sideways, as has been clear for the last few trading sessions or so. Once again, I think this is third or fourth day in a row, the implied open at 8 a.m. is down about 70, 75 odd points or so. Sonia.
Absolutely. Hi, morning. Morning, Nigel. There's another thing you can do, right, which is look for good quality stocks whenever the market pulls back, because that's generally been the best template for long-term investors. Having said that, this is a pullback, of course. That's what you're seeing on the market, and looks like even this morning it's going to be pretty much in the red. So if you just take stock of what's happened in the last couple of months, right, the Nifty is now down about 3% from the 20th July high that we saw of almost 20,000 on the index. So in that context, there's definitely a pullback that we've seen, but more so in the broader markets and in the Nifty Bank. So just look at that. The Nifty Bank is down about 5%, and the pressure has really come in the heavyweights. Reliance is now down 10% from the highs that we saw in July. ITC, there's HDFC Bank and the others. So if you're a long-term investor, perhaps you'd want to sort of take stock of the large caps that are falling and maybe, create some sort of a shopping basket. But of course, having said that, this is a choppy market with a downside bias. If you look at, the US markets, we've been talking about that ad nauseum, 300 points almost gone on the index overnight. And the US 10-year yield is at the highest level since October of 2022 as well. And there is selling pressure in our own markets. The FIs have been selling now consistently. So both foreign and domestic investors sold in the cash markets yesterday. So FIs sold about 1,500 crores, and put together in the month of August alone, it's almost 10,000 crores that has gone from the FIIs. The other thing, a couple of things to watch out for, there's definitely risk aversion globally. So you're seeing it across asset classes, whether you look at gold, which is at a 5-month low, whether you look at cryptocurrencies. We don't generally talk about it, but there was a weird slide that we saw, 9% slide overnight in the Bitcoin, and now it's back closer to $25,000. So there's this wave of a sell-off across all asset classes globally, and India is not too far behind. I mean, we've already seen a 3-4% fall from the top.
Well, that's right. The bulls got a bit of a challenge on their hands, Sonia, today, because the Nifty needs to defend that 19,428 odd mark to avert a fourth straight week that we're going to end lower. Now, we haven't seen something like that all the way since April to May 2022. So, we'll like to avert that. So, we'll have to put on close to around 70 points odd, which is unlikely today. At the start, at least, we're going to start off with the cutoff around 70 points. What's weighing on the Nifty? In the past 1 month or so, the Nifty Bank is down close to around 5%. ITC, it almost went to 500 rupees odd on 24th of July. And from there, it's corrected close to around 12%. You have a big pocket of the market that's dragging both those two sectors. Now, can the Nifty be third time lucky? Earlier this week, well, we went to around 19,250. We went even to 19,300. And from there, we bounced 150 to around 170 points. Today as well, going by the pre-open rates, we'll be starting in that vicinity of around 19,250 to around 19,300. Looking at the options data, the highest open interest comes in at around 19,400 call. The premium out there is close to around 90 rupees approximately, and there's aggressive writing being seen at around the 19,400 call. On the downside though, yesterday, the 19,400 put, well, that was active. It added close to around 20 lakh shares. The premium out there was around 110 rupees. So you deduct 110 from around 19,400, you come to around 19,290. And that will be a crucial support zone that perfectly tallies in with the 50 DMA. And also the low that we had earlier this week. So those are the crucial support zones that you're looking at. Remember, to get past, to get into that bull trend yet again, you need to get past the 19,600 odd, which is the 20 DMA. So that's the crucial support level you're looking at. On the Nifty Bank as well, the low that we saw earlier this week comes up for you on the screen, 43,600 odd, and the 100 DMA as well is in that vicinity. So you can pull back maybe close to around 0.7%, odd, but you'll not like to break that level on a closing basis. Since the GIFT Nifty is suggesting that you're likely to start off, the implied opening will be down close to around 82 points odd. If you're a scalper, that is, you have a high risk appetite, maybe you look to buy in that vicinity of around 19,250 to around 19,300. Keep a stop loss of around 50 points approximately. But otherwise, the global Q is a little bit dicey. You have flows as well that are not supporting us. So maybe you want to sit out of that. But if you're a scalper, maybe look to buy in that vicinity.
Also, if you notice this month, the entire month, the stocks that have fallen the most are the domestic consumption-oriented stocks, whether it's banks like SBI, whether it's Hero MotoCorp, Britannia, Asian Paints. And now with inflation rising so much, there is, of course, this whole narrative about how domestic consumption could slow down further. That is a big fear as well that the market is looking at. So not just global, but locally as well. The post the inflation data, there are a little bit of fears of that.
Well, yields are rising everywhere, right? Not just the U.S. We talk about the U.S., but Europe. Except China is rising everywhere. I mean, China is, of course, going in reverse. But well, that's the setup overall. Before we get started and tell you more, let's quickly run you through the things lined up in the first half hour of the show. We get you updates from markets across the globe. Harold van der Linde of HSBC will join in to discuss the global setup. Our research team will bring you CNBC TV 18's list of top 10 stocks for the day. And at 8:30, we will talk fundamentals. Deepan Mehta of Elixir Equities joins in.
Okay, let's also get you some rupee views, some money market views rather. Lakshmanan V of Federal Bank says the hawkish FOMC meeting minutes aided the dollar index to trade at a 2-month high as most of the G7s were trading lower against the US dollar yesterday. He says the Chinese yuan and the Japanese yen trading at a 9-month low are also exerting pressure on the rupee. He adds that central bank's action is in both spot as well as in non-deliverable forwards will be vital. He expects the rupee to trade in a range of 82.86 to 83.48 for the next few trading sessions.
Okay, we've got Lakshmanan weighing in on bonds as well, saying that the US 10-year rates above 4.3% is likely to hold an Indian 10-year bond yield well above 7.2%. Incremental cash reserve ratio driven reduced system liquidity would keep the near ends too high. With the Treasury bills inching closer to 7.1% mark, it may stay at these levels or even higher.